Hey guys, welcome to another video. In this video, I'll be talking about AS20, which is earnings per share, right? I'll be discussing only the concepts in this, right? The concepts and the basics. And in another video, I'll be solving around 40 to 50 questions. Okay, so in the next video, probably I'll be solving 40 to 50 questions, or maybe I'll do live. Whoever wants to join, they can join. Okay, let's just start off with this EPS. Okay, so earnings per share. uh, I'll just start off with the applicability first. For listed companies and for unlisted company whose net worth is 250 crore or more, they will have to follow Ind AS, okay, which is the IFRS equivalent for India. Okay, so they will have to follow Ind AS 33. Okay, which also deals with EPS itself. Okay, so Ind AS 33 deals with EPS. That will come in final, I think, right? So and in cases of unlisted company whose net worth is less than 250 crore, they will have to follow AS20. Okay, so here obviously other entities won't come because common sense, right? Earnings per share will come only where shares are involved. Okay, so in case of partnership firms or any other type of entity where shares are not involved, obviously earnings per share is not applicable to them. Okay. Next, objective. What is the objective of earnings per share? See, not everybody is an expert in analysis of financial statements or the financials. So, the most basic way of measuring performance will be through the EPS. Okay, so for that reason, this particular standard was brought in, right? So it is to enable the investors to compare performance based on earnings. EPS is to be shown on the face of the P&L statement. Okay, so at the bottom, after earnings, after the net profit, everything is given, you'll find something written as EPS in the bottom. Okay, so it is mandatory to show EPS for companies. Okay. Next, the types of EPS are basic EPS and the diluted EPS. Okay, so first, both of them are mandatory. Okay, you cannot pick and choose whether you want to show only basic or whether you want to show only diluted as per your needs. No, you have to show both basic and diluted EPS will have to be shown. Okay, and EPS is to be reported even if the earnings are nil. Okay, if earnings are nil, you just have to put a dash. If it is negative, then you have to put the negative number, obviously. Okay. Next. Here. Okay, so we'll just discuss about basic EPS first. Okay, so in basic EPS, it's very simple. EPS, earnings per share, is the amount of earnings you have. Earnings, there's only two earnings of equity shareholders. Okay, earnings of equity shareholders divided by the weighted average number of shares. Okay, weighted average number of shares. Okay, that to equity shares. Okay, weighted average number of equity shares. Okay, we'll just discuss what forms part of earnings for equity shareholders. Okay, so after we discuss that, then we'll discuss what is supposed to be part of weighted average number of equity shares. Okay, like various different cases. Okay, firstly, when it comes to earnings available to equity shareholders, we'll start off with EBIT, which is earnings before interest and tax, and then we'll subtract interest from that, we'll subtract the tax from that, and then we'll subtract the preference dividend that is to be paid, and then we'll end up with earnings available to equity shareholders. Okay, so in cases there are obviously various scenarios that may arise, so we'll just discuss that one by one. Okay, so in case there is any prior period item, meaning if there's any prior period item, meaning previous years, suppose you forgot to include, let's say the current year is 2024, right? So you forgot to include something in 2023. So according to AS20, you're not allowed to make backdated changes. You cannot make that change back in 2023. You will have to show that change in 2024 itself. Okay, so that change you will have to show in 2024, and it will form part of this 2024 EPS itself. You cannot change the previous year's EPS. Okay, so according to AS20, any prior period items are to be adjusted in the current year, and no backdated adjustments are allowed. Okay, so in this case, I'll just explain it again. So in case any prior period item is present, it has to be adjusted in the current year itself. You cannot make backdated adjustments, meaning it cannot be adjusted in the previous year, because then that will cause change in the previous year EPS, which is not allowed. Okay, next, extraordinary items require separate disclosures. Okay, if there are any extraordinary items, right? Extraordinary items, we'll discuss that. That is a separate EPS or separate accounting standard altogether, right? So if there is any extraordinary items, then you'll have to disclose it 4 times. Okay, one is basic EPS before extraordinary items, basic EPS after extraordinary items, diluted EPS before extraordinary items, and diluted EPS after extraordinary items. So a total of 4 times, 1, 2, 3, and 4. Okay, so total 4 disclosures will have to be made in case there are extraordinary items. Okay, next. Now when it comes to dividend on preference shares, okay, so preference shares dividend, it's kind of peculiar. Okay, preference share dividend. Okay, so in this case it depends on whether it is cumulative or not. Okay, so if it is cumulative, what does cumulative mean? Cumulative preference share means whether the company has profit or not, that dividend will get accrued to the person or to the preference shareholder. Okay, so whether there is profit or not. Okay, suppose I do not have enough profit this year, then I will have to accumulate that preference shareholders dividend and pay it with next year's dividend. Okay, is that clear? I think that's as clear as I can make it. Okay, so if there is not enough profit this year, meaning I cannot pay that preference shareholder this year, then I will have to accumulate that, meaning it will get paid in the next year. Okay, so in case of non-cumulative, if there is no sufficient profit this year, then the preference shareholders won't get any dividend. He won't get it in the next year also. It's just gone. No profit means he won't get any dividend. So that is non-cumulative. Okay, he will get dividend only if there is profit. Okay, so when you're calculating earnings available to equity shareholders, that time if they've given any cumulative preference shares, in case of cumulative preference shares, you will have to make adjustment regardless of profit or loss. Okay, so if it is cumulative, right? If it is cumulative, then make adjustment. Whether profit or loss, you have to make adjustment. Okay, profit or loss, make adjustment. Okay, in case the dividend or in case the preference share is non-cumulative. Okay, if it is non-cumulative, you'll have to make adjustment only if there is profit. Okay, make adjustment only when there is profit. Okay, meaning suppose you have earnings per share, earnings available to equity shareholders, and they've given that dividend on non-cumulative preference shares have been adjusted, and there is no profit. Okay, so suppose there is a loss. Okay, so suppose I'll just write it. Okay, suppose earnings available to equity shareholders is negative. Okay, it is let's say minus 1000. Okay, so in this case, if there is a cumulative preference shares, right, what do I do? Should I make adjustment? Yes, I should make adjustment. If there is non-cumulative preference shares, then I should not make any adjustment. Okay, because I should make adjustment for non-cumulative preference shares only when there is profit. Is that clear? Okay. Next, earnings should be taken before making any appropriation to reserves. Okay, so any general reserve or any reserves in surplus or any building reserve, any other kind of reserve. Okay, so before making any appropriation to the reserve, you will have to take that earnings. Okay, they would have given earnings. EAES is after making general reserve, like all these etc. Okay, so you'll have to add all this back to EAES. Okay, is that clear? I'll just give a recap. Okay, we'll just go through it once. Okay, in the first case, any prior period items are to be adjusted in the current year only. Okay, backdated adjustments are not allowed. Okay, so no backdated adjustments. Okay, clear? Next, extraordinary items require separate disclosure. If there is extraordinary items, then you will have to disclose EPS 4 times. Okay, this is basic EPS before extraordinary, basic EPS after extraordinary, diluted before extraordinary, and diluted after extraordinary. Okay. Next, if there is dividend on preference shares and that preference shares is cumulative, then whether there is profit or loss, make the adjustment into earnings available to equity shareholders. In case the dividend is of non-cumulative preference shares, then make adjustment only if there is profit. And lastly, earnings should be taken before making any appropriation to any reserves. Okay, is that clear? So we have discussed about the earnings available to equity shareholders. Okay, so what comes under earnings available to equity shareholders, and that too this is for basic EPS only. Okay, this is for basic EPS only. Okay, we'll discuss diluted EPS down below. Okay, next weighted average number of equity shares. Okay, so how do you find out weighted average number of equity shares? Firstly, you take the number of shares. Okay, number of shares into period outstanding. Okay, meaning for how long that particular number of shares existed. Okay, period outstanding rather. Okay, so suppose there was a share that was issued in the middle of the year. Okay, middle of the financial year. Then it existed, it was outstanding only for the 6 months, right? So you will have to give it only 6 months worth of weight. Okay, so suppose 1000 shares were issued only after the first half, meaning only for 6 months, right? So 1000 shares into 6 divided by 12. So that way you get the weighted average number of shares. Okay, so what do you do in these cases? What do you do if there is what do you do if there is buyback of shares? What do you do if there are different face values? Different face values can be of two types again, which is equal rights and differential rights. And there can be different paid up values also. There can be rights issue, right? And there could be a bonus issue also. I think bonus issue covered up here. I think bonus issue is quite simple. Even if it's not here, I think I can cover that. Okay. Next. So in this case, in the case of buyback, so you'll have to subtract that from the period in which such buyback was made. Okay. For example, from 1st of April to 30th June, right? 1st of April to 30th June, let's say there was 1500 shares. Okay, and then 500 shares were bought back on 500 shares buyback. Okay, 500 buyback. Okay, in 30th of June, and the year ends on 31st of March, right? So here 1500 shares existed only for the period between 1st of April to 30th June, right? So 1500 into, calculate the number of months, so April, May and June, right? So 3 months into 3 by 12. So how much will that be? 1500 into 3 by 12, that will come up to 375. Okay, so 375. And then now since 500 shares were bought back in the middle of the year, right? So you'll have to subtract from the period in which such buyback was made, right? So from June to March, those shares did not exist, correct? Because those shares were bought back. So how many shares existed? Only 1500 minus 500. So only 1000 shares existed for the remainder, right? So 1000 into 9 by 12. So that will come out to 750. Okay. So in this case, in the case where buyback was there, the weighted average number of shares, right? So this will be the weighted average number of shares will be 375 plus 750. That will come up to 1125. Okay. Is that, I think that should be clear, right? In case of buyback, what should be done, right? So it could be anywhere in between. So you just have to change the number of months in between. Okay, cool. Next we'll move on to the next part, the next adjustment. There is different face values. Okay, so different face values of equal rights. Okay, so first what do you do in case they've given, let's say 10,000 rupees or 10,000 shares at 5 rupees, and then 10,000 shares at 10 rupees, and then 5,000 shares at, let's just assume 20 rupees. Okay, so you just pick one base. Let's just assume 10 rupees as the base for this case, right? So you just pick one amount as base, one face value as base. Okay, we'll just call this A, B and C. So class A and class B and class C. Okay, so we'll just take one. It doesn't matter, you can take any one as base, basically you just have to convert all of them into a single face value. Okay, so you have to make this so make all of them into 10 rupees, right? So here this 10,000, this is the number, right? This is the number, then this is per share, right? So in case of A, right, we're converting everything into 10 rupees, right? So in case of A, how many number of shares? So there are 10,000 shares at 5 rupees now, but we want it to be 10 rupees. So what will be the amount? So it will be 10,000 into 5 divided by 10. 10,000 into 5 divided by 10. So that is 5,000 shares. Okay, so you'll have to convert. This is 5,000 at 10 rupees, right? So the same way B will already be at 10 rupees. So 10,000 at 10, right? 10,000 at 10. Now in case of C, again there are 5,000 shares at 20 rupees, but we want it to be 10 rupees each, right? So 5,000 into 20, so 5,000 into 20 divided by 10, so that will come out to again 10,000 shares at 10 rupees. Okay, so these are the amounts. Okay, so in this case the weighted average will be 5,000 plus 10,000 plus 10,000, so 25,000. Your weighted average number, I don't have space here, so the weighted average number will be 25,000. I hope that's clear, right? So and then you will just have to take that as the base, take that 25,000 as the base, right? After you take that 25,000 as the base, whatever earnings available to equity shareholders you get, we'll just EAES, right? And then we'll just assume the earnings per share is around 50 rupees. Okay, so this 50 rupees is for 10 rupee value. Okay, so this 50 rupees is for 10 rupee face value. We just have to convert it to the 5 rupees, the 10 rupees, and the 20 rupees face value. Okay, so in case of the face value 5 rupees, right, which is A class, right? This is class A, this is class B, and this is class C, right? We'll just put EPS in this column. Okay. This is just an example, right? So so now since the EPS is 50, right? So EPS is 50 for 10 rupees. We just put 50 in the 10 rupee place. Okay, so that should be easy, right? Now when it comes to 5 rupees, so it's just basically cross multiply. Okay, so if EPS is 50 for 10 rupee face value, how much is it for 5 rupee face value, right? So it will be 50 into 5 divided by 10, right? 50 into 5 divided by 10. So you'll get earnings per share for this is 25 rupees per share. And then for in case of face value of 20 rupees, again same thing, 50 rupees for 10. How much is it for 20 rupees face value? So 50 into 20 divided by 10. So you'll get 100 rupees earnings per share. Okay, is that clear? I think that should be clear, right? That is in case of equal rights. Okay, for differential rights, I'll just explain the steps now, and then we'll see it in the actual problem. Okay, because I don't think I think it'll take quite a bit of time, and it'll be confusing to do it without the actual sum, right? So basically what is happening here is in case of different face values, okay, just to give you a reference of where we are right now, we are studying the basic EPS. Okay, basic EPS, and then we found out the formula, which is earnings available to equity shareholders divided by weighted average number of shares. Okay, we discussed what are the adjustments that could be found in earnings available to equity shareholders. Okay, we found all these four different or 4 or 5 different adjustments, right? Now we are discussing about the adjustments that can arise in weighted average number of shares, meaning what are the adjustments that we'll have to do in the denominator. Is that clear? Okay, just to give you guys a reference in case you've wandered off or something. Okay, so in this case, in the case where there are different face values, okay, so there are different face values and there are different rights, meaning each share is entitled to a different rate of dividend. Okay, so suppose class A is entitled to the normal dividend. Okay, the normal dividend, but B is entitled to 20% extra. Okay, and C is also entitled to 10% extra. Okay, we're talking about dividend here. Okay, so extra dividend basically. Okay, even also here also extra dividend, right? So so different classes of shares are entitled to different rates of or different dividends, right? Or extra dividends basically. So you just take the total EAE that you find out, okay, by doing the following, doing that EAES normal calculation, right? Don't subtract anything else. Okay, from this EAES you just subtract the extra dividend, which was supposed to be given to B and C, right? So you just remove the extra dividend. Okay, so after you remove the extra dividend, you get the normal dividend. Okay, once you get the normal dividend, you will have to like this is the or rather sorry, you get the normal EAE. Okay, you get the normal earnings. Okay, so that will be your numerator. Okay, this normal EAE will be in your numerator, and then you will have to convert all the shares or all the classes into a single face value, same as this step, the same as the converting, and then find out the EPS and then reconvert it back. Okay, reconvert the EPS back to the different face values. Okay, so there's one extra step. So after you reconvert the EPS, you'll have to add this extra EPS to the respective classes. Okay, so I understand this could be a bit confusing now, but when we do the sum, it will be very easy. I'll guarantee you that. Okay. I think there are like two or three sums which have this, and like there, I think like your concepts will be even more clear. Okay, next in case of different paid up values. Okay, here there's nothing, just convert all into fully paid up shares. Okay, if they're given any partly paid up shares, doesn't matter, convert them into fully paid up. Okay, so in case where somebody pays in the middle of the year. Okay, so suppose there was 1000 fully paid up. Okay, so 1000 into 10 fully paid up, and then there were like, let's say 50 into 5 5 paid up, right? 5, that is out of 10, right? So in this, the number of equity shares will be 1000 into 10, and how much are 50 into 5? 50 into 5 by 10. So how much will that be? 50 into 5 by 10, that will be 25, right? So that will be the number of shares. So yeah, so here will be 1000 shares, and then here will be only 25 shares. So 1000 plus 25. So we're only finding out the number of shares. Okay, so here obviously this 1000 will take completely, and then but in this 50 of 5 partially paid up, we will take only 25. So total weighted average number of shares will be 1025. Okay, in this case there's no need to reconvert the EPS. Okay, unless there's a separate class with different face value. Okay, here we're just converting it into paid up value. Okay, there's no need to reconvert the EPS into different paid up values. That is not required. Okay, next, in case of rights issue. Okay, so this is very important. Okay, like lots of questions are based around rights issue itself. Okay, like I can show you almost 10 to 15 questions that have been asked in the previous exams that relate to rights issue in this chapter itself. Okay, so I'll just discuss the steps. Okay. So firstly, I'll just introduce you to some terms. Okay, so this is the X right price. What does the X right price mean? X right price means the price that is after issue. Okay, so so let's just assume before the issue there was only 5000 shares. Okay, 5000 shares that existed at a market price of, let's say, 50 rupees. Okay, so this is the price that existed previously, right? So how much will this be? 5000 into 50, this will be 2,50,000, right? This will be 2,50,000. So now what we're going to do is we're going to add how much rights issue we made. We'll just assume we made 1000 rights issue at what is the right price? We'll just assume 40 as the right price. Okay, so here 10,000 into 40. So here we received almost 4 lakhs, right? Something doesn't add up here. 2,50,000 into 40, that is 40,000. Sorry, yeah. So 40,000. So total it's worth 2,90,000, right? Divided by how many shares did we issue? Here 1000 shares, and here sorry, here 5000 shares, and here 1000 shares. So 5000 plus 1000. So total of 6000 shares are there, right? So 2,90,000 divided by 6,000, right? So how much will this be? 2,90,000 divided by 6,000. So this will come up to 48.3, right? Meaning this is the price after the rights issue has been made. Okay, so this is like the right price, or this is the price after right issue. Okay, so why do we need that? We need that to calculate the okay, so we'll have to bring all of them to equal quantity, right? The shares that existed prior. Okay, so let's just assume this is I'll just remove all this. Okay, let's just assume the timeline. Okay, so in 1st of April so in 1st of April there is let's just so in 1st of April there were 5,000 shares, right? We'll just assume in the center, rather in September, we made a rights issue. Okay, so these are pre-write. Okay, so these are pre-write amount. Okay, pre-write, but these values, okay, these shares whatever comes afterwards will be post-write, right? These will be at post-write value. Okay, so why we need this is to convert the pre-write into post-write. So we're converting pre-write into post-write, right? So what we are trying to do here is we are trying to convert the pre-write into post-write. Okay, so we're bringing all of them into the same we're trying to balance each other out. Okay, so we cannot take one post-write and one pre-write, so we're bringing all of it to post-write value. Okay, or rather x-write value. Okay, instead of post I'll just put x-write. Okay, so this is pre-write value and this is x-write value. So whatever was pre-write number of shares, we're bringing it into x-write number of shares. Okay, so that is what we're trying to do. Okay, so firstly, the same procedure that we followed. Okay, we just have to take the original number of shares and then multiply it with the pre-write market price per share. Okay, so how much ever original shares that existed before the right issue, you take that and then you multiply it with the pre-write market price of the shares. Okay, so this will be given in the question. So this will be given in the question. This will also be given in the question, right? So this will also be given in the question. This will also be given in the question. This will also be given in the question. So everything in the numerator will be given in the question. Even everything in the denominator will also be given in the question. So there is no need to worry about anything. Okay, so this is just to calculate how much the value of shares is after the right issue. Okay, so basically what will happen in this case is so we just assume here it was 100 rupees and then right shares of 1000 into let's just assume 80 rupees. Okay, so here what are we going to do? How many shares existed pre-write? So 5,000 shares existed pre-write. Okay, so original number of shares into market price. This is the market price. Okay, so into 100 plus how many right shares did we issue? We issued 1000 right shares into 80, right? So at 80 rupees, right? So into 80 rupees, and then we'll divide it by the number of shares. Okay, how many original shares are there? There were 5,000 original shares and then 1000 right shares. So what will this be equal to? So this will be 5,000 into 100, that is 5 lakh, plus 1000 into 80, that is 80,000. So 5,80,000 on the numerator, divided by 6,000, right? So divided by 6,000, that will give us 96.67 rupees. Okay, so this is the X right price. So this is the price after right issue has been made. Okay, now, so I'm sure the first step is clear. Okay, right? So now we will have to calculate RA factor. RA factor is the right adjustment factor. Okay, so right adjustment factor. Okay, so basically what we're going to find out is what is the amount that is to be multiplied. Okay, so this is the amount. Okay, so basically RA factor is the amount that is to be multiplied to pre-write number. Okay, is to be multiplied to pre-write to make it into post-write or to make it into X-write. Okay, Suppose in that example there were 5,000 shares, right? So 5,000 shares were from what? April, May, June, July, August and September, right? So for 6 months into 6 by 12 into the right adjustment factor. Okay, so when we do this, we will get the weighted average number of shares, correct? We'll get the weighted average number of shares, but this weighted average number of shares will be x right weighted average number of shares. Okay, is that clear? Right. We'll just move on. Okay, I think that is pretty clear, right? So what RA factor does is it will convert pre-right weighted average number of shares into x right weighted number of shares. Okay, so RA factor will convert pre-right weighted average number of shares into x right weighted average number of shares. Okay, next we'll have to calculate WANES. Okay, the weighted average number of shares. Okay, as we had discussed, as per the period, you know, like how for the period outstanding, right? So we'll have to calculate WANES according to the period outstanding. Okay, we'll just solve a couple of sums in the next video. Okay, this is only for concepts. Okay, so the first step is we'll have to find out what the x right price is, right? I just forgot to explain what this RA factor does. Okay, how to find the RA factor. Okay, so RA factor is you just have to divide market price before right issue upon the x right price which you found in the first step. Meaning in this first step which you found this x right price, okay, the same x right price you will have to divide it by or rather the market price divided by the x right price. Okay, so then you will get the right adjustment factor. So again, what does right adjustment factor do? Right adjustment factor converts your pre-right weighted average number of shares into x right weighted number of shares. Okay, weighted average number of shares. Okay, next. Next. So apply right adjustment factor to the original outstanding shares. Okay, so your x right, meaning the amount that you are calculating after the rights issue will already be x right price itself. Okay, will already be x right number itself. Okay, so you'll have to use it only for the original, meaning only for that 5,000 original 5,000 shares you will have to use the RA factor. Okay, because afterwards when you calculate the weighted average number including the right issue, then it is already x right. Okay, so you're just converting this pre-right number into x right number. Okay, is that clear? Next, so number of shares before right issue into the RA factor into number of months it is outstanding. Okay, so that time you'll get the weighted average number of shares. Obviously along with this you will have to do the I'll just write it here. Okay, plus right issue plus the original plus right issue into a number of months. Okay, it's not only for the original one. Obviously the post right number of post the number of shares after the rights issue will also have to add to the weighted average number of shares. Okay. Next, and then obviously then you will calculate the EPS and you will calculate the restated EPS. Okay, so why you will have to calculate the restated EPS is because in the previous year, right, suppose in 2024 you have issued right shares, so obviously there might be changes in your EPS, right? So because of the right issue it might not be proper, right? So I mean, like, that comparison won't be true because there is rights issue over here but there's no rights shares over here, or rather there is right shares over here but there is no right shares over here, right? So you'll have to multiply whatever the WANES of the previous year is, weighted average number of shares, with the right adjustment factor. Okay, so you'll have the earnings available to equity shareholders divided of 2023, and then you'll have the divided by weighted average number of shares of 2023, that you will just have to multiply with RA factor. You will get the 2023 restated. Okay, so basically you'll have to write basic EPS of 2024 2024, right, is equal to just X amount, right, and then BEPS of 2023 dash original, meaning whatever it was last year, okay, and then BEPS 2023 restated. So it will be 3 times, okay, restated. So in restated, you will put this formula EAE. You will just multiply the RA factor in the denominator, okay. Next, in case of diluted EPS, what does diluted EPS mean? Diluted EPS takes into consideration any potential equity shares also into consideration. Suppose there is any convertible debentures, or there are any convertible preference shares, you will have to give effect to it as though they were equity shares itself, okay. So as though they have already been converted into equity shares in the current year itself. So that is the effect that you will have to give to them while calculating diluted EPS, okay. So whether it is diluted or not depends on the question, the adjustments in the question, okay. So we'll just call it adjusted BEPS, okay. Only if that adjusted BEPS is lower than the basic earnings per share, okay. Only if the adjusted earnings per share is less than the basic earnings per share, only then it will be called diluted, okay. But if this adjusted is more, if it is more than the BEPS, then we won't call it diluted, okay. It is anti-dilutive, and we are not going to show any anti-dilution, okay. We're not going to show any anti-dilutive EPS. We're going to show only dilutive EPS, okay. So firstly, we'll just write adjusted earnings per share, and if that adjusted earnings per share is less than the basic earnings per share, only then we will consider it dilutive EPS, okay. If it is more than the basic EPS, we will not disclose. We just put it as dash, okay. okay. First, we'll just go through it, okay. Only when adjusted BEPS is less than basic earning per share, it shall be considered as dilutive, okay. We can show the reduction in BEPS, but we cannot show increase. There's obviously the common sense conclusion, right? So if adjusted BEPS is more than the basic EPS, then you will have to disclose it in the following way. Whatever the basic EPS is, you will have to disclose that amount, and for dilutive EPS, you'll just have to put a dash, or this dash you'll have to show, okay. If both are equal, meaning both basic and dilutive are equal, you can show it in a single line, or rather you have to show it in a single line, okay. So BEPS and DEPS is equal to either nil or the amount, okay. That is basically diluted EPS. Basically you're giving consideration to any potential equity shares, meaning any potential or any security that can convert itself into equity shares, and you will also consider the potential savings in it also, meaning if that for example, if preference shares or debentures get converted, you no longer have to pay the dividend or interest, right? Dividend in case of preference shares and interest in case of debentures, right? So you will no longer be required to pay this. So those are the potential savings. So those potential savings you will add to the earnings, and the potential conversions you will add to the weighted average number of shares, okay. So here, so what comes under adjusted earnings available to equity shareholders? What comes under adjusted EAE? Okay, first is your normal earnings plus any potential earnings due to conversion, okay. So in case of interest or preference dividend, those are our only potential savings actually. No other security gives any potential savings, okay. So interest in case of debentures or bonds, debenture, I mean there's no convertible, I don't think there's any convertible bond, but in case of convertible debentures, preference dividend in case of convertible preference shares, okay. Next, in case of adjusted weighted average number of shares, in this case we'll have to consider any convertible debentures, convertible preference shares, any share warrants, employee stock option plan, or any share suspense, okay. So all of these are potential equity shares, meaning you will have to add this to the denominator, okay. So this potential savings you're adding to the numerator, okay, numerator, and any potential or adjusted ones, any potential equity shares you will add to the denominator, okay, right. Next, Okay, what is a potential equity share? A contract that entitles or may entitle its holders to equity shares in the future. A contract that entitles or may entitle its holder to equity shares in the future. Okay. Next. So if there is no potential savings in ESOP. Okay. So obviously ESOP is given at a very reduced cost, right? So there's no savings, like you're not incurring any interest or dividend, or rather a preference dividend, you're not incurring anything. So there's no potential savings in that case, and share warrants are attached to the share application, right? So there is a completely separate topic which I won't be spending time on. Basically, if they give share warrants, there's no potential savings in it, okay, because you're not paying any interest or any dividend on that. Okay, next. Okay, so if there are multiple potential equity shares, meaning if they've given like ESOP, if they've given share warrant, if they've given convertible preference shares, if they've given convertible debentures, in all of it in one sum itself, in that what you have to do in that case, you'll have to find incremental EPS, meaning you'll have to find out what the EPS will be in each scenario. Okay, so for example, I'll zoom in out here. Okay, so for example, they've given ESOP, right? In case of ESOP, there will be potential savings is 0, right? So potential savings is 0, and potential conversion, let's just assume 5,000. Okay, we'll just assume 5,000 for everything. Okay, so in this, obviously the incremental EPS is 0, right? And then we'll just assume there is cumulative preference shares. Okay, preference shares. Okay, let's just assume every year there will be almost 50,000 rupees in savings. Okay, so this 50,000 in savings divided by 5,000, right? So what is this 50,000 divided by 5,000? So this will come up to 10, right? And then we'll just assume there is debentures also. Debentures is potential savings of, let's just say only 2,000 rupees every year, and 5,000 potential equity shares. So what will that come to? 2,000 divided by 5,000. Okay, so you'll have to do only like potential savings of debentures, potential equity from convertible debentures. Same thing for each particular potential conversion, right? For ESOP, how much savings will be there? Savings is always 0 for ESOP, and potential conversion is how much ever they've given the question, right? In case of preference shares, there will be potential savings in the form of preference dividend and potential equity shares also. Okay, so in this case, what is this 2,000 divided by 5,000 will be 0.4. Okay, so in this case, you will have to give it rank based on ascending order, meaning the lowest will get the first rank. Okay, so in this case, you'll have to give 0 the first rank, 0.4 the second rank, and preference share the third rank. Okay, so this is the first step. Okay, you'll have to find out incremental EPS, meaning only for that particular item you'll have to find potential savings divided by potential convertible equity shares. Okay, or increase in shares basically. Okay, next, rank incremental EPS based on low to high basis, right? So the lower one will get the first rank, and then following the next lower, the next lower, the next lower, right? So low to high basis, you'll have to give it ranks. Okay, next. So lower increment will always show dilution, meaning in case of EPS, right? In case of ESOP, when there was 0 incremental EPS, that will always reduce your EPS. Okay, because there is always a dilution there. Okay, that is because there is increase in denominator, but there is no increase in numerator. So that's why there is. That's why it is dilutive, meaning it will reduce the EPS, right? So that will always be dilutive. Okay, in cases of ESOP and share warrants, it is always dilutive in nature. Okay, so it will always cause dilution. Okay, next. Next, adjust each potential share in diluted EPS based on ranks, meaning first we got EPS, right? Suppose we have the basic EPS. Let's just assume over here, just put EPS over here. We'll just put the EAES over here, earnings available, and then we'll put the number of shares here. Okay, the WANES, okay, the weighted average number of shares, okay, and then we'll put the items one by one, okay. So this is the adjusted EPS, okay, or the adjusted EPS. Let's just assume the starting, right? The starting one, let's just assume it is let's 5 lakh divided by 10,000 shares, okay. So 5 lakh divided by 10,000 shares will be the 50 rupees EPS, okay. It's 50, okay. Now when we bring in ESOP, so when we bring in ESOP into this case, so the potential savings here is 0, right? So potential savings here is 0, but we are going to divide it by the additional we'll just assume 5,000, okay. So here what you have to do is you just have to add these two, which is 5 lakh divided by the sum of these two, which is 15,000 divided by 15,000. So there's a dilution, right? So over here it is coming from 50 to 33.33 the EPS, so there is dilution, okay. So this is diluted. Next we'll bring in the debentures, okay. Next we'll bring in the debentures. So in debentures there was a savings of 2,000 rupees, right? But there was an increase in WANES of 5,000 rupees. So that was next in our rank, right? First was ESOP, second was debentures, and last one was the preference dividends, right? Conversion of preference dividend, okay. So here we'll just add all of these together, right? So 5 lakh plus 2,000, so that will come up to 5 lakh 2,000, right? Divided by 10 plus 5 plus 5, that is 20. 5 lakh 2,000 divided by 20,000 shares, that will come to 25.1. So this is also dilutive, right? So as of now our dilutive EPS is 25.1, okay. So this is our DEPS as of now, okay. And then now we'll bring in the preference shares also, okay. We'll just bring in the preference shares, okay. So in case of preference shares, what did we see then? We saw that there was potential savings of 10,000 rupees, okay. There was potential savings of 10,000 rupees, but there was increase of 5,000 again, okay. So in this case add all of this together. So there's 5 lakh plus 2,000 plus 10,000, right? So 5 lakh 12,000, that will become 5 lakh 12,000 divided by 10,000 plus 5,000, 15, 20, 25. So divided by 25,000, so in this case it is becoming 20.48, okay. For example, if this so in case of this, instead of being we'll just increase in, for this example we'll just take this potential savings as 50,000, okay. So if the potential savings were 50,000, okay, so 5 lakh plus 2,000 plus 50,000, so 5 lakh 52,000 would be the earnings divided by 25,000. So this is coming up to still 22.08, okay. We'll just have to reduce this weighted average number of shares, okay. We'll just take this as 500 only, okay. So here like why I want, what I'm trying to show is, in case this increases, like from 25 it becomes 26, right? This is anti-dilutive, so you're not allowed to take this anymore, and you're not allowed to take anything that comes after this also, because those are anti-dilutive. So the last DEPS, the most dilution is at this point, which is 25.1 rupee, okay, which is 25.1 rupee, okay. Is that clear? Next. So our objective is to identify the maximum dilution in basic EPS in all adjustments and report the same in the P&L, okay. So that is in case where all potential conversions are given in the question, okay. All, like preference dividend is given, rather convertible preference share is given, convertible debentures are given, share warrants are given, ESOP is given, right? So in all, if all of it are given in one question, then these are the steps to be followed. I'll just give a recap, okay. So first you'll have to calculate incremental EPS for each item, for ESOP separately, for debentures separately, for preference shares separately, for share warrants separately, okay. How will you find the incremental EPS? You will see the potential savings divided by the increase in number of shares for each particular item, meaning for ESOP the potential savings will be 0 and the increase in shares will be whatever is given in the question, and in case of preference or rather convertible preference shares, the potential savings will be the preference dividend divided by the increase in number of shares given in the question, right? So you will find out incremental EPS, and in the second step you will rank incremental EPS on low to high basis. Whichever is lower, you will give it the first rank, and you will follow it to the next highest one, right, or the next lowest one rather. Okay, so you will give it ranks like that, and then you will slowly add one by one to the EPS which you have already calculated until you find the maximum dilution. Okay, once it starts becoming anti-dilutive, meaning in that case where we saw where it was 50 and then it became 30 and then it became 25 and then it became 26, this is allowed, this is dilutive, but this is not dilutive. Okay, you just have to write non-dilutive, and this 25 rupees will be your DEPS or your dilutive earnings per share. Okay, right? Next. Diluted EPS for loss making company. If a company is loss making, then dilutive EPS will be disclosed only if loss per share is increased after adjusting, meaning obviously if there is a loss making company, meaning they already have minus 10 EPS. So if they have already minus 10 EPS, then if loss per share increases, meaning if it becomes 12 rupees, only then we will disclose it. But if it becomes minus 9 rupees, it is anti-dilutive, right? Because negative, it is opposite, right? So if it becomes, if the loss per share reduces, then it is anti-dilutive. If the loss per share increases, then we will have to show it. Okay, I will just read it again. Okay, if a company is loss making, then dilutive EPS will be disclosed only if loss per share increases after adjusting potential equity share. If the loss per share after adjusting the potential equity share declines, then it will be considered as anti-dilutive and not reported. That's pretty basic common sense, right? So these are the places where mistakes can be made. So I've just put this big danger symbol, right? Or here, if convertible securities are issued in the current year, meaning if they're issued in the middle of the year, okay, then you will have to give the time factor. Okay, usually if the convertible shares, this is in case of dilutive EPS. Okay, in case of dilutive EPS, if in the current year when you are calculating the dilutive EPS, it was issued in the middle of the year. Okay, so when you're adding that to the denominator, meaning when you're adding it to the increase in shares, in this increase in shares, you will have to give the time factor as, I mean, you'll have to consider time factor, meaning whatever you get into 3 by 12 or like whatever number of months into number of months, right? Is that clear? I think that is clear enough. Okay, and this is for both savings and for increase in shares. Okay, so from the date of issue to balance sheet date only, this is the only time period you will have to consider it for. Okay, not before the issue, obviously, right? So if it is if any convertible securities, be it convertible preference shares, convertible debentures, ESOP, share warrant, whatever, right? If it is being issued in the current year, then you will have to consider time factor from the date it was issued to the balance sheet date, meaning the date on which that balance sheet is being prepared. Okay, next. And same logic if there is conversion. Okay, if there is any conversion in the middle of the year, if the shares are being converted in the middle of the year, then you will have to give it then you will have to consider time factor from the beginning of the year to the date of conversion only. Okay, for the purpose of DEPS. Okay, and then obviously after it gets converted from here, you will be treating it as normal shares itself, so it will form part of your basic EPS itself. Okay, next. Now, share split or consolidation. In case where shares were split, EPS will be based on new number of shares and restated for last year by adjusting number of shares. Okay, so obviously you'll have to give one basic EPS, which is the original, what is shown for the current year, like basis BEPS for current year, right? And then BEPS or BEPS for previous year original. Okay, and then BEPS for previous year restated, and same thing for diluted also. Okay. Basically what you have to keep in keep in mind is that it is EPS is always shown on the new number of shares. Okay, and you'll have to restate the previous year's earnings per share also. Okay, next, earnings per share for discontinued operations. Okay, so earnings per share for discontinued operations. So here you will have to show under 3 headings. Okay, firstly, EPS of continuing operations, and if there are extraordinary items, then you'll have to further divide into 2 parts. Okay, one is before extraordinary items and after extraordinary items. Firstly, continuing operations, before extraordinary, after extraordinary. EPS from discontinuing operations, before extraordinary and after extraordinary, and then the total EPS. Total EPS again before extraordinary and after extraordinary. I think that is pretty much it. Okay. Okay, thank you for watching. In I'll be solving the sums of this chapter in the next video, or maybe in the coming week. Definitely sometime next week. Do let me know in the comments whether you want it in on live. You want me to do it live with you guys, like showing the question paper on this side and solving on the other side, or whether I should just record it like this and upload it. Okay. Cool. Thanks for watching. This is the concepts for EPS AS 20, Accounting Standard 20, earnings per share, basics and concepts. Thank you. See you. Tata. Bye bye.